Hello, good evening, everyone. A very warm welcome to you, and thank you for coming to attend tonight's webinar, Navigating Rising Interest Rates and War. My name is Richard, and I'll be your host today. And if you have not already done so, please support our organizer and media partners by joining their Telegram channels so that you can be kept posted of upcoming events as well as market insights. All right, so just search for Online Traders Club, Wealth and Joy, or Retirement in Telegram app. So without further ado, let me now continue. Now, where do you think the market is heading and how is the market today? Right? Some of you may say that it is recovering. Some of you may say that it is still going down. Some of you may say that it is very volatile, right? So, well, let's take a look at the picture, which will speak a thousand words, all right? So, to me, this is what the market looks like. You know, when we talk about market, usually we refer to the S&P 500, and since the beginning of the year, we have been on a downtrend, right? With a lower low and lower high. So that also forms a downtrend line marked by the pink line. And what happens in the past few weeks? Well, I think the market has staged a pretty incredible recovery. And we kind of just climb above the resistance now turn support line, which is marked by the blue line. So where would the market go from here? Will it be a false breakout, or will the market continue to break new highs in the coming weeks? Bearing in mind that we are now in a rising interest rate environment with a record high inflation and a pandemic plus a war. My goodness, I don't know how often in history have we got so many incredible things happening all at the same time. And who knows that the market might just be climbing on a higher high, just like what happened during the pandemic. Or maybe it will take a turn for the worse should any of those incidents or issues take a turn for the worse. Well, I'm not the expert here, so tonight we will hear from the two invited speakers who are the experts on this topic. But before that, please allow me to introduce the organizer, and which I'm a part of, who is Online Traders Club Singapore, or OTCS. And we are a non-profit society formed in 2005. That's pretty many years ago already. And we are a community of traders and investors, and we are run by a group of volunteers. Right? So to me, OTCS stands for a place where we network, share, and learn, and we do it through a series of workshops, courses, and a library. And these are some of the workshops and webinars that we have held. Obviously, these are photos are taken before the pandemic. And we aim to have about 10 to 12 a year. And it is free for our members to attend. But because of the pandemic, we have moved entirely online, and we make available our webinars entirely for free for all, not just to our members. And this is one of the last big scale events that we have, and it is conducted at SGX Auditorium, who is our sponsor for the venue. And it was a great place to be, you know, before the pandemic. Yeah, so I look forward to be able to have such in-person events again and see all of you in persons in not hopefully a not too distant future. As for courses, we aim to have about 3 to 6 a year. And what we normally do is that we will go to a good trainer, and then we will do a group buy and ask for a group buy discount from the trainer for our members to attend. All right. So these pictures are taken from some of the courses that we have had down through the years. And as for our library, we have over $6,000 worth of resources. And if you want to know what they are, you can download the PDF from our website, onlinetradersclub.org. But the thing is that due to the pandemic, the library is closed. And when it is open again, we will make the announcement. So again, OTCS to me is a place where we network, share, and learn. And we do it through a series of workshops, courses, and our library. So the next question is, how much it is to join as a member? Well, the normal fee to join as a member is $120 Singapore dollars a year, but for a limited time only, it is $60 a year. And this offer is still on at the moment. In fact, right now it's free. So maybe we will reinstate the membership fee when we have physical meetings again. But meanwhile, take full advantage of our online sessions, which is entirely free for our members as well as the public. And if you want to be kept posted of our upcoming events, please join our Telegram channel by searching for Online Traders Club in Telegram app or subscribe to our mailing list on our website. And again, if you just join us, please don't forget to support our media partners, Wealth and Joy, and My Stocks Investing by joining their Telegram channel by searching for Wealth and Joy and Retirement in Telegram. And also a special shout out to you, Savvy, who is also our media partner. And I also like to give a shout out to the OTCS crew who are members of our community who volunteer their time to help us out during the physical events. And you know who you are, and we thank you for doing all the background work behind the scenes for our physical events. And with that, I'd like to now read up the disclaimer, very important. You are responsible for your own profits and losses. The speaker's opinions are their own and does not represent OTCS opinions. OTCS, its office holders, associates, and sponsors are not responsible nor liable for your losses. And OTCS events are for educational purposes only and should not be construed as advice. Now, when you're in doubt, please seek professional help. Okay, where's a mouthful? Okay, so tonight's topic is navigating the rising interest rates and war. And with us, we have two speakers, Mr. Sani Hamid and Kenny Low. So who are they? Well, our first speaker, Mr. Sani Hamid, is the Director of Wealth Management in Financial Alliance, one of the largest independent advisory in Singapore. Sunny has nearly 30 years of working experience in the financial markets and is often invited by the media to share his opinion and insights about the markets. And our second speaker is Mr. Kenny Low. He is a MAS licensed independent financial advisor and associate wealth advisory director who specializes in portfolio construction and REITs. He is also a SGX Academy and IBF certified course trainer. Like Sunny, Kenny is also often invited by the media to share his insights. Now, an interesting fun fact, Sunny and Kenny have been close buddies for over 30 years, so it is really nice to have both of them speaking in the same webinar today. So, without further ado, can I hand over the stage to our first speaker, Mr. Sani Hamid? Sunny, you need to unmute yourself.
Ah,
Yes, done.
got it raised. Okay, sorry about that. Yep.
No
So let me
worries.
grab the screen from you.
Sure.
Stop sharing. Okay. Share screen.
While Sunny is sharing the screen,
Mm.
over the course of the whole webinar, if any of you have questions for Sunny or Kenny, please feel free to type it into the chat box you see on the screen. If you're using a desktop computer, it is on the bottom right. If you're using a mobile device, you will need to scroll up or down to look for the chat box. So feel free to type in your questions anytime, and I will ask them on your behalf at the end of their sharing.
Okay. Thank you, Richard. Can you see my slides and can you hear me clearly?
I can see and hear you, but I have not seen your slides.
Nope, you can't see the slides. Sorry.
Yeah, do you need to grant it permission or something?
Um, it says here you are now sharing your entire screen.
Oh, then we wait for a little bit longer.
Wait a second.
Or maybe you want to try again.
Yeah, I'll try again.
Now we are back.
Can you see my slides?
Let's give you a few seconds. Nope.
No, that's strange.
Yeah, let's
Okay,
try again.
let
No
me-
worries.
Okay. Because I can see it on my side. Not sure why.
Hmm. You're using Chrome, right?
Yes, I am. The same
Hmm.
one that we was
Tested,
using
huh?
just tested on just a while ago.
Yeah. We had just a dry run just now. Would you like to try restarting?
I'll go out and come back in again.
Okay, sure.
Yeah. Okay, give me a second.
Okay,
Sorry about that.
no worries. Well, to the attendees who have just joined us, sorry for the technical difficulty we are facing. We, in fact, have tested out the setup just before the webinar, and still something like this can happen. Well, it happens. We do have some friends watching the session in YouTube. If you like to ask questions to Sunny or Kenny later, I think it will be better that you join us inside the webinar room so that you can type in your questions for them to answer at the end of the session. So if you're watching us on YouTube live, please consider to join us inside the webinar room. If you want to know what is the link, please go to onlinetradersclub.org and click on the events link, and there will be the link to join inside the webinar room. All right, so meanwhile, let us give Sunny a few minutes to restart his computer and join us back inside the webinar room. Okay, meanwhile, please enjoy the elevator music.
Hi, Richard. Can you see my slides?
Nope. Well, alternatively, you can send the slides to me. Then I will be your clicker.
Let me just try and share the entire another part of the screen. Hang on.
Okay.
What about this? Can you see this?
It's show loading.
Still not yet.
Still loading, is it?
So I think it's not coming out. So would you prefer that you send me the screen the PPT, and then I will be your clicker?
Hey, Richard, can you see my slide?
你也在 share 啊？
我在 share，你可以看到哦，我的。
No, not yet.
Okay 啦 I can see my screen.
Oh, that's weird.
Let's stop share.
Okay. Okay, I will share mine. I'll share mine. Okay, can you see my screen, Kenny?
Loading.
Okay.
It may be a speed issue.
Oh, that's
Still,
unusual.
yeah, still
Even mine is not coming out. Huh?
Mm.
Just now, did mine come up at the
Just
beginning?
now, beginning, yes. Now come up.
Okay, so there's quite a lag. So now you can see my screen.
Yes. You,
Okay.
you switch to next slide to see what's the lag. Okay, switch
Switch
already.
already.
Yeah. So
Okay.
it's a loading portion. So
Okay.
just wait for maybe 30 minutes or 1 minute to load. 30 seconds to 1 minute to load.
Okay, now I press. Press.
Yeah.
Press.
Okay.
So I think the very first slide takes a bit longer. You want to try again? Kenny, you try yours while we're waiting for Sunny.
Okay.
So you stop my sharing. Okay, to all the attendees, very sorry. We are having a little bit of technical difficulties at the moment. When we try it out just before the session starts, things are working, but when the actual show starts and we face the difficulty. I appreciate your kind patience with us.
Yep. Richard.
Okay, let's wait for, I see it says screen loading. We wait for maybe 1 minute. Okay, Sunny has sent me the slides. Let me load it up as a standby. Sunny, I received your slides.
Okay.
So let me load it up and see whether it appears or not. Okay, Kenny, I see your slide. Then it disappeared.
I took it. Sorry, I
Okay.
didn't realize.
Okay. I tell you what, Sunny, you try.
Let me just try.
Try one
Yeah,
more
one more
time.
time.
Yeah.
Okay, give me a second.
Sunny, you need about 1 minute to load
For the first slide.
Oh, is it?
Yeah.
Okay.
to our first slide.
Yeah. After that, it should be okay. We tested it while you are away.
Okay, give me a second.
So again, for all the attendees, thank you for your kind patience while we sort out this technical difficulty. We have tested it out before the session start and it was working, but now we face this issue.
Yeah,
So,
I'm sharing it now. So
okay, let's wait for 1 minute.
Oh, is it? Okay.
The very first slide seems to take longer.
Yeah, next time shouldn't have this problem because next time you'll be the physical seminar.
Okay, let's give it another 20 to 30 seconds. Yes, it is out.
Really? Oh, okay.
Excellent.
Okay.
All right. So to all the attendees, thank you for your patience. We are going to start the webinar proper. And for those of you who are watching on YouTube Live, you may want to consider watching us inside the webinar room. And if you have questions anytime, please feel free to type it into the chat box on the screen. If you're using a desktop device, it is on the bottom right. If you're using a mobile device, you will need to scroll up or down to look for the chat box. And feel free to type it in anytime, and I will ask them on your behalf to our speakers tonight late at the end of their sharing. So, Sunny, so sorry to trouble you with all these technical difficulties.
Not at all. Not your fault. No worries. Yeah, it
and,
happened. Yeah.
The stage is all yours now.
Okay, thank you very much. So my apologies to everybody. As usual, despite doing what needed to be done, things sometimes just go wrong. And thank you for your patience. Thank you very much for inviting me today to share my views on the markets. As you can see, the title is Navigating Rising Rates and War. I'll talk about this and also other stuff. And as usual, I need to highlight the disclaimer. Whatever I say is for education purpose. It's me sharing my thoughts on where I think the markets are going. Any reference to any particular name or investment, again, please bear in mind that you should seek your financial advisor's opinion or recommendation. And also any performance figures are past performance and not indication of future performance. Okay. All right. I think before we go into the so-called presentation proper, just a very quick glance as to what's happening in markets. Year to date, as we can see, the markets basically are gyrating roughly around neutral, around zero. We've got some markets slightly on the upper hand or the upper side, Brazil, some of the commodity markets. On the other hand, we have some markets like China, -8, Korea, -7. And of course, we have that particular outlier, which is Russia at -40. But roughly on average, if you average it out, I think you'll probably get somewhere around 0% on average returns for most of the equity markets overall in general. Okay. All right. Really where we stand today, I think the big question everybody's asking themselves is, where are we headed to? And since I'm talking to a group of investors, seasoned investors, I think we all know that markets basically move in three directions. It's either up, down, or sideways. So really, that's the question we have to ask. And I'm going to try and give you my thoughts on some of the factors which would potentially push markets higher, push markets sideways, and even push market lower. And from there, I think we can come to kind of like a bit of a probability as to maybe where we think markets potentially could be going. Okay. So the three paths that we're taking, at first and foremost, I'm taking the S&P 500 as a proxy, given that it's really the leading indices or index, which leads every other indices that we see. Everybody tends to follow Wall Street and such. Of course, there are differentiations, but I'm just taking this as an easy guide overall. If you look at the S&P 500, what we've done is since the COVID rally, we've kind of broken this trend line. Markets went down and now are pushing higher. From here, really, there are three directions that market can go. Is number one is we are just going to go back into the path of the previous trend and continue with what we've seen since last year and even for the past couple of years. Okay, so that's really the first path that we could be taking. The second path that the market could take is basically one of a downtrend. I think many of you are familiar with reversal patterns. One of the most famous reversal patterns, of course, something called the 1-2-3 reversal, 1-2-3 bearish. There are many names people call it. And basically this is where after breaking a trend line, the market rebounds, but a failure to actually retake back what we call the previous highs, resulting in a breakdown, would actually cause the market to resume or rather start what we call a downtrend. Okay, so this also is another path that the market could take. And the third path that the market could actually take is that of a sideways consolidation. Okay, and typically that's where the support line here, and this is just graphically, this is taken as an example in some textbook, technical analysis textbook, that if the support line holds here, then what you have is you have a market that's going to move sideways and consolidate rather than go down. So big question, where are we headed? It's path one, path two, or even path three, and that's what we're going to try and answer today in this particular session itself. Okay. Path one, okay, resuming the uptrend. In my view, resuming the uptrend, one of the key reasons why we would expect a resumption of the uptrend is QE resumes. I think we all know that QE now has potentially come to an end, but one of the key factors which I think could push the market back into that particular trend is QE. But prior to that, let's just have a kind of visual look at where the markets are. The markets today, compared to where we were in 2000 dot-com peak, 2008 global financial crisis peak, the markets are now here today. And if we say that we expect the markets to resume, we are expecting the markets then to rejoin this particular rally that we've seen. A bit of a exponential move here, but generally the trend was here and then exponentially after COVID here. So we're saying the market's going to go there. Okay, as you can see, I've drawn the arrow like really all the way up here. So it's kind of like telling you it really has to go exponential in order to rejoin the markets again. Why do I say that QE has to be a key factor or primary factor? Well, because over the past 10 years, the red line and this chart on the right-hand side, that basically is the S&P 500. Okay, the blue line is what we call the total assets of the Federal Reserve, European Central Bank, BOJ. So this is really the quantitative easing by the three major central banks in the world. And as you can see, there is this correlation between markets going up and also money being pumped into the system. And I think it just makes absolute sense that liquidity makes its way into the system, finds its way into risky assets, and risky assets go up. So naturally speaking, if the Federal Reserve and many of the central banks were to open back the tap of quantitative easing, then one can actually imagine that we could be seeing a resumption of the uptrend as the chart on the left hand side. Okay. One other thing that we also want to take into consideration is the fact that there is already a lot of liquidity in the system. If I want to just go back one chart here, sorry. Okay, if you look at the blue line, which is the amount of money that's being printed into the system in the system itself, although it doesn't show here the Federal Reserve, the Federal Reserve today at this particular point in time is about $9 trillion of assets, meaning to say they printed about $9 trillion. Right prior to the crisis in 2008, that was 1 trillion. So basically what we've seen over the past 10, 12 years is the Federal Reserve has printed roughly about 9 times more than it had right prior to the crisis. Okay, so basically we have a lot of liquidity in the system. And where does this liquidity sit? Of course, it sits by the sidelines when people are worried. And this chart shows it very clearly. This is the retail money market fund chart. The peaks here shows you that people are worried. People push money to what we call retail money market funds. And when you look at these peaks here, basically they coincide with what we call areas, shaded areas, which represent recessions and periods of time where there's uncertainty. So every time the money moves out from the sidelines back into risky assets, i.e. there's a drawdown, you see that the markets move up. Okay, so basically even in this particular period itself, the market went up, and now we are basically at a point whereby it is again showing signs of coming off, i.e. Market is actually or money is actually making its way back into the system itself. Okay. So if that is the case, well, this is a very strong argument to say that as liquidity moves into the system again, into risky assets, it could propel the S&P 500 and indices higher from here. Okay. The other thing which I would like to point out is the path 2. And path 2 actually is the sideways situation. Okay. The sideways situation is basically whereby the markets actually move sideways. The previous one I showed you was actually potentially market moving higher. The market would move sideways is actually nothing abnormal, or at least something that we've seen before. The first time we saw markets actually move sideways was basically when in the 1970s we had this oil crisis. Prior to that, right after the war, the market actually did a 17x, meaning to say it moved up by 17 times from the bottom of the war all the way up to the early 1970s. Before what we call the oil crisis kicked in, there were two major oil crises during the 1970s. So throughout this whole decade itself, the markets, as you can see, if you follow this line that I'm drawing here, it actually went nowhere. Although there was a decline and there was an increase and then a decline at the end of this period, markets basically, if you were to buy here and hold it all the way here, you would have gone nowhere, i.e. markets move sideways. So this is a kind of an example of a sideways market, and right after the so-called very strong post-World War II rally. The 1980s, 1990s rally, which was a 13x rally, all the way after the oil crisis. So again, oil crisis was a consolidation, and then markets moved higher. It kind of peaked in the year 2000 with the dot-com crisis, dot-com bubble bursting. Okay, and the markets actually moved sideways. Although it didn't feel as though the market moved sideways because it felt market went down and then there was a strong rally. But if you take like 10 steps back and look at it from this perspective, and if you just draw a line from the top of the dot-com bubble, it was the same top at the global financial crisis, and it was the same top again in 2013. Basically, anybody holding from the year 2000 to 2013, it would have just gone sideways and not gone anywhere if you just base it on the S&P 500. So that really is a sideways kind of consolidation. So again, we saw a consolidation right after a very strong uptrend from the post 1980, 1990s rally itself. right now. A lot of you may be asking, how many X have we done since then? Well, since 2009, we've gone up 6X. Okay, and again, the numbers are larger because we're not starting with small numbers and the indexes. We're starting with large numbers. So 6X is relatively large when you look at the nominal index number. Okay, so we're here right now. The question again, as I mentioned, if we're going to take this path, is potentially we could be seeing markets moving sideways from here and over potentially even an extended period, because we really have gone up quite a lot. Okay, similar to the previous two examples where the 13x and so on was followed by almost a decade-long kind of sideways. But within the sideways, there are opportunities, because these sideways can be quite large and quite wide. And so there are really opportunities to still make money, but in general terms, it's still a sideways market, so to say. Okay. And logically, from a fundamental perspective, one could make an argument that, if quantitative easing is coming to an end, if the Federal Reserve decides to then now switch to quantitative tightening, then naturally speaking, the markets potentially would have topped out. Because why? As I've earlier alluded to the fact, there's a very strong correlation between liquidity being pumped into the system via quantitative easing and the movement in risky assets, for example, the S&P 500. And so if this figure here on the left-hand side, if that's going to come off, then naturally speaking, we could see a top on the S&P 500, and from here onwards, potentially a sideways movement. Okay, so the top side seems to be capped by the current policy of the Federal Reserve, which is to, i.e., stop quantitative easing. That in itself tells us that the top side probably we're near there, or at least that would keep markets capped from that perspective. Okay. Interestingly, I think since we are going into this quantitative tightening period, interestingly is the Federal Reserve did attempt before in the year 2014, 2015, 2016 to do quantitative tightening. As you can see here, they were actually on the path of tightening liquidity until COVID hit, and they just ramped up the printing presses. But prior to that, actually, the Federal Reserve and many central banks were already trying to initiate what we call quantitative tightening. So let's have a look at what happened during this quantitative tightening to try and give us an idea of how that could actually impact markets going ahead. If you look at this particular chart itself, this is just a period of time when I showed you earlier, during that period where the Federal Reserve, which is in this red line, was trying to actually do quantitative tightening. Okay. So what happened was, in that early stage prior to doing quantitative tightening, the Federal Reserve actually communicated to the markets quite strongly in order to prepare the markets that, hey, we're going to do quantitative tightening. We're going to the balance sheets, we're not going to print any more money. Okay, we're going to stop printing, and we're telling you early on. And this was really the signaling phase. And during the signaling phase, the balance sheet still grew. Okay, but dates were being set, and the S&P still grew by about 40%. Then came the period of time where the balance sheet actually moved nowhere, i.e., if you can see here, it actually declined by very small, about 2%, but that's really sideways movement. The stock market actually still went up by about 40%. And it was actually this period of time where there was an actual withdrawal of liquidity from the system itself, and the balance sheet shrunk. And this was where the stock market, while going up 7%, you could see it was really a very, very choppy period during this time. So one could say that it was during the withdrawal of liquidity that really the stock market didn't really like it, and kind of moved sideways and became quite choppy. And this is really that period that we're entering into, because there's a lot of talk of the Federal Reserve now looking at quantitative tightening much earlier than we expected. So we initially expected maybe end of 2.2, early 2.3 before they start withdrawing liquidity. There's already talk they're going to withdraw liquidity maybe in the second half of this year itself. At the same time, people may be worried about interest rates going higher, and the interest rates have started to creep higher, both on the long end of the curve, and also we've got the so-called Federal Reserve initiating signaling, several increases, including potentially 50 basis point and such. But if you look back into history, this red line here is basically the 10-year Treasury. The blue line is the S&P 500. During periods where we saw the 10-year Treasury spike up, and these are really quite sharp spikes. If you can see here, in 2013, it spiked up from 1.6 to almost 3.2, almost doubling. Here, 1.4 to maybe about 2.6 or 2.8. And again here, during these three periods where the treasury yields spiked up, the blue line, which is the S&P 500, still actually started to chug along pretty okay, and even went up, so to say. It was only during this period here that it was a little bit choppy, but still overall, you can see that interest rates, while having a kind of like a negative sentiment overhang on markets, I think what happened is, as long as there's a lot of liquidity in the system itself, it tends to overshadow what we call the normal traditional thinking that higher rates would actually flip the market over, heading, pushing it down and such. If there's sufficient liquidity in the system, that could actually be the overarching kind of consideration, and markets don't actually go down despite the fact interest rates go up. One thing I want to bring, and this is a note here, which is basically, don't be surprised if the Federal Reserve and many central banks in the world are actually going to be pushed into a corner because growth is going to slow. Right now, there are not many people talking about a recession. Some people are starting to talk about slower growth, and we can talk about what we call stagflation and such. But the signs are already there that we could be actually facing, or there could be in the pipeline, slower economic growth. Rather than look at numbers which are coincidental or lagging, we look at numbers which are considered to be leading indicators. The OECD prints out a composite leading indicator, and this leading indicator has already been showing over the past couple of months that we're at the top of the cycle, and going ahead, many G7 economies, including China, Europe, US, and such, these are actually showing signs of a peak in growth and actually coming off. And these are indicators which suggest not growth slowing now, but growth slowing in the next 3 months, 6 months, 1 quarter, 2 quarters, 3 quarters ahead. Okay. Another indicator that's being closely followed by many people is that of the so-called global credit impulse. Global credit impulse, or credit impulse itself, it tells you the amount of private credit that makes its way into the economy. And as we all know, private credit, or loans, in other words, is needed in order to oil the economy, to fuel the economy and such. So if there's a lack of credit going into the real economy, then you would expect basically growth to slow, economic activity to slow. And we've been seeing that in a sense that if I try and do what we call a cyclical trend, it's not very nice. It doesn't follow very. I mean, I try and mirror this so-called red line up there. You can jolly well see that we are at a point here, and this was in the last quarter of last year, that this was actually a down cycle in the so-called global credit impulse, i.e., the amount of private credit going into the global system actually was slowing at that point in time. The important thing to know is private credit leads economic growth, which means that basically, as the loans are made, the loans then go into the hands of people who borrow, who then go and make purchases of hard assets, machineries, and so on and so forth. Okay, so there's really this kind of 6 months time, even 9 months lag. So when economists do this kind of lag, and they match together, for example, in this particular case, the G3 credit impulse, and they lagged it by 12 months, it kind of becomes a leading indicator. So the blue line is the credit impulse, which has already begun, but the light blue line is the global manufacturing PMI, which is still basically at this current point in time, late 2021. But what it does suggest is, based on what we've seen on the credit impulse, i.e., lower amount of private credit going to the economy, we can expect the global PMI also to come off. And again, the correlation has been relatively strong, so to say. Similarly, it's the same thing when you do kind of a lagging indicator type of matching, when you talk about the government 10-year yields. So 10-year yields, while is going higher, if the economy starts to slow, we actually could see 10-year yields come off, as being suggested by the credit impulse. Side note, if we are looking at what we call slower economic growth, and we are still looking at inflation remaining pretty high, guess which asset is probably going to do very, very well? And the answer is here right in front of you. It's probably going to be gold. Gold is one asset which does very well in a stagflationary environment, low growth and high inflation. Um, this is an environment where the so-called real interest rates start to tumble. If you just look at this chart itself, the red line is gold price. The blue line is what we call the so-called real interest rates, but it's a derived real interest rates based on U.S. market treasuries and so on. Okay, it's an index link, so we just take it as real interest rates. You can see that there's really kind of like a mirror image between real interest rates and gold prices, almost a one-to-one mirror image. When real interest rates go down, gold prices go up, and vice versa. When real interest rates go up, gold comes down. So basically, what has happened is for quite some time, we've had relatively high inflation, and then we've had the Federal Reserve starting to hike rates and such. So based on those two things, you get what we call a real interest rate, which is almost sideways or neutral. Because again, real interest rates is nominal rates minus inflation. Okay? But if real interest rates are coming down, meaning to say if the economic growth is slowing and many of the central banks are then forced to rethink their tightening monetary policy stance, and they need to actually then loosen monetary policy, you will see real interest rates start to come off, which means gold prices going higher. And I think we're kind of seeing that in gold prices as it slowly nudges up, not only on the Ukraine factor, but I think increasingly on anticipation of slower economic growth. I've spoken about earlier on how basically the top side of the range could be capped. The bottom side of this range, and if we move in path 2, i.e. we move sideways, okay, the bottom side of the range could be supported also by quite a few things. One is, of course, liquidity moving from the sidelines, and also liquidity switching from different asset classes. This particular chart shows what we call mutual funds. The blue line is equity mutual funds, and the red line is bond mutual funds. Okay, so there has been this huge influx of money into the bond mutual funds, actually, over the past 10 over years compared to that of equity mutual funds. But with interest rates higher, with inflation higher, there are really signs that potentially some of the money here may actually start to move into here, resulting in the blue line starting to move up. So that could potentially be a reason. If equity markets come down, there could be a switching from bonds over to equities, thus supporting markets, thus keeping markets in a range. Also be on the lookout for buybacks. While buybacks have actually tapered off a bit, I think they're starting to come back. And buybacks are very important, especially in the US. This is a very famous chart by Deutsche Bank in one of their research papers. They showed this particular chart, which says a lot. And let me just unpack this chart for you. The various lines here represent basically the so-called purchases in the US, okay, in the US stock market. If you look since 2009 to 2019, when the report was released, almost all categories were actually either negative net purchases of stocks or even just a slight net purchase of stocks, which is the foreign sector. US pension funds, households were all negative. The only guy or the only variable or the only sector that was actually strong net buyer of stocks was non-financial corporations, non-bank corporations, which is i.e. corporations. Your Apple, your Netflixes, your IT companies, your Microsofts, Boeing, and so on. These were guys who were buying back their own stocks. And really, that if you look at how the S&P 500 and Wall Street in general had performed from 2009 all the way to 2019, where it was almost like just one way up, the main driver of that increase was basically stock buybacks. Companies were buying back the stocks, supply of stocks decrease, i.e. demand remains the same or demand increases at the same time because of quantitative easing. You have an imbalance between demand and supply, and guess where prices go? And this was very evident because when you look at Europe, and I'll show you this is very interesting. Europe also had quantitative easing. If you look at my cursor here, Europe was actually quantitative easing was relatively large, although not as large as that of the US. Europe was from 1 trillion all the way to 5 trillion. US was higher than that. Um, um, Actually, almost the same. Actually, US the one that when diagonal was actually after COVID. So fair to say that actually Europe was as strong as the US. But when you look at the European stock market didn't go anywhere. over the same period that Europe printed massive amount of liquidity, the stock market declined. Of course, there was huge amount of problems with Greece and so on, and then ended up here. So the stock, the liquidity actually didn't propel the stock market as high as it did in the US. And one of the reasons was, if you look at the tradition of stock buybacks in Europe, it is much lower than that of the US. So what happened was the printing of money made its way into the markets, but it wasn't making its way, or rather, it made its way into the economy, but wasn't making its way into the stock market. So buyback was that bridge to actually bring the liquidity and translate it into what we call a higher stock market via corporates buying back their own shares. Okay, so this is very interesting, and I think we should be looking out for news. If we do see a lot of buybacks, I think that's one key indication that we potentially could see markets being supported to the downside. Right. So we come to the interesting part now, path 3, which is down. Um, if you look at the markets, and many of you are again techies, and you look at charts, and I think we all know this particular dotted line is that line that everybody is focusing on. Okay, so this is the one where it has to hold. If it doesn't, we could jolly well be seeing quite a deep dive back to potentially a supporting trend line, which is, maybe what, 20% lower and such. So this is really is the part. So big question now is, will this hold, or what could trigger this to give way? I think that's a key thing. Interestingly enough, I've been asking myself, if something does happen, will it look like 2000 or will it look like 2008? If you remember, in 2000, what we had was, we actually had the bursting of the dot-com bubble initially. And when the market kind of, went down, yeah, fine, kind of wanted to recover, we then had the Enron, WorldCom, Arthur Anderson corporate scandals and such. And then the market took one down leg further. And then the market wanted to recover, and then came the 9/11 attacks. And the market took another down leg. And then the market wanted to recover, came SARS, and took another down leg. And then there was the Iraqi war, or the invasion of Iraq, which was associated with September 11, and that really put the market here. And but market then after that started to recover. But because of mutually exclusive and things which were more or less not tied to one another, occurring one after another, the markets actually took about 3 years, from the year 2000 to 2003, before it recovered. So this is really one interesting scenario, because it wasn't really the same as 2008, where it was just one big messy, everything within the same confined space, i.e. the bursting of the so-called subprime bubble. There were banks failing, so everything was confined to the internally to the financial sector. Whereas here, as you can see, there were external factors, there were corporate factors, there was a virus, and there was a war and such. Okay. So between the two, it does look like, if we were to have a domino effect in this particular cycle, it does already looks a little bit like this. We've got a war, we've got a virus, we've got potentially a market bursting, and so on. And we don't know what's lying underneath the waves and such. But anyway, just to tell you that, look out for this. It could be a series of it could potentially be a series of dominoes rather than just one particular factor itself. Okay. And the dominoes are lined up. The markets are not cheap. Look at any historical way of valuing the markets, and you'll find that the markets are expensive. In terms of where they are, how many standard deviation they are away from their PE, their historical average PE, and they're really, at least 2 standard deviation. And sometimes it's different because you have different calculation, but roughly 1 or even 2 standard deviations. So they're quite far from where we consider them to be fairly valued, and not even undervalued at this particular point. Yeah. And this chart is very interesting. I like to show this chart. This is again a very macro chart, and it shows basically GDP and what we call net worth of household. And the net worth of households are basically made up of things like ownership of assets, stocks, bonds, property, things, your asset side of your balance sheet, basically. Okay, and as you can see, during the 1950s all the way to the 1990s, the wealth of the household was actually in line with GDP. So you could say that basically asset prices was in line with what we call fundamentals. Okay, but interestingly enough, and bear in mind this period of time, 1950 to 1990, This blue part here is the 1950 to 1990s, where actually it moved in tandem, but it started to then deviate. Asset prices started to then move ahead of the so-called general economy. And this is where the argument of Wall Street being way, way far ahead of Main Street, the real economy. And this due to, printing of money, due to, leverage and derivatives and so on and so on and so on. And it always is the fact that crisis, recessions try and bring this dispersion back to equilibrium. So we see basically at the dot-com crisis, it tried to come back, but then it took off again. During the global financial crisis, it moved away from, so fundamentals, or rather markets moved away from fundamentals, or net worth moved away from fundamentals. And then the crisis and the recession try and push it back to equilibrium. Today we are here, which again is no surprise because the amount of money that was printed in the system has just fueled asset prices sky high. Okay, so now if you just based on this particular valuation, asset prices, net worth is basically so much more higher than real fundamentals, which is way down here. So it does suggest that there is really a unique situation which Warren Buffett, who uses this indicator, and many of you will be familiar with, where he measures what we call the market size compared to that of the real economy. So it's basically the value of all the market cap of the stock market over the GDP. So in theory, basically, you can't have a stock market which is so much more larger than the real economy, because the stock market, after all, is a representation of the real economy. Okay, so they will reach a point where if the stock market is too large, it tends to deflate, because why? Again, it can't detach itself from the real economy, because it is, after all, a representation of the real economy. But if you throw in trillions and trillions and trillions of dollars, you can have a situation where it just balloons all the way to 200%, twice as big as the real economy. And this is really where Warren Buffett, has a lot of cash sitting by the sideline, because this is one of his favorite indicators, so to say. Okay, so we have a stock market really which is very large relative to where the real economy is, and I think this chart and the previous chart alludes to that. So what could force the market below that trend line which I showed you, or that particular important line which would trigger a down move? There are a few things in my view, and I mean there could be many things, but I'm just trying to bring up one or two things. One is policy mistakes. And policy mistakes because the Federal Reserve has had, over the past 10 years, a very easy job. They were worried about deflation. Okay, the way to combat deflation is to increase asset prices, to create what we call a wealth effect, and so not to fall into what we call the Japanese deflationary trap, or liquidity trap, so to say. So therefore, every time the market came down, they would actually accommodate with low interest rates, with more money being pumped into the system, and so on. So that created what we call the so-called Fed put situation. But now it's a totally different story, because if the market comes down, it's going to be extremely difficult for the Federal Reserve to do what they have been doing over the past 10 years. They can't, like, markets coming down, I need to create a wealth effect. I'm going to pump in more liquidity. I'm going to bring rates down. But hey, guess what? Inflation is in the picture. This thing which didn't exist over the past 10 years, which allowed me to do whatever I wanted to do, now is pegging me down, because how can I reduce rates when inflation is? And that is really why the communication from the Federal Reserve, because their main mandate of any central bank is actually price stability. So we may be kind of, we don't be surprised if we see markets coming down, Federal Reserve not doing anything, because the markets are not really their first priority. It's price stability. Okay, so again, this is what we call policy missteps, where they have to really balance this kind of situation where there's inflation, there's growth, which takes priority, and then there's also the markets. So Muhammad Al Irian has put this in a very nice kind of a way in an article. Say, yeah, this is really one thing that we ought to be looking out for. Okay. Of course, we know that Ukraine could also be a trigger to bring markets below. And honestly speaking, 3 weeks ago, when the markets were sitting at that particular support line, I was having sleepless nights, because if that had gone past it, I'm pretty sure a lot of stops would have been triggered and we would have taken a new down leg and such. Okay, so back then, and these two slides, it was taken actually from a presentation I gave about 2-3 weeks ago, but it talks about the best case and worst case. The best case, of course, is a win-win situation, and a win-win doesn't necessarily mean a real win in a sense. It just means that, you know, Russia is allowed, Putin is allowed to go back to the Russian public to say that, you know, I've done what I've managed to, or we've reached our objectives. We are okay. We've done well. You know, there wasn't a loss and stuff. Very similar to the Cuban Missile Crisis, whereby basically it ended in basically both parties being able to go back to their countries, or at least to their voters, to say that basically we've won, or we've managed to diffuse this, and so on. So that really is that win-win situation. Okay, the worrisome thing was that basically, and although now there are indications that Zelensky is saying, you know, we could remain neutral and so there are signs that we could be going down this road of having a win-win situation. I think markets pricing that in, but we still have to be very careful, because one of the key things which we don't want to happen is, and many people have been warning about this, is to actually push Russia, especially Putin, into a corner. It's really where he has nothing to lose. So things like, and in fact, these are coming out from the US media, things like Biden calling him a war criminal, and bringing, Russia to the World Criminal Justice Court and stuff. So all these things actually push Russia into a corner and Putin in a corner, and that's quite dangerous in many views of many analysts and such. Okay, so right now, I don't think we have a clear idea of which is going to be the case. So therefore, it still leaves open that potential break of that support line, which I think we still need to pay attention to very, very closely. Okay. All right. So I kind of given you the three scenarios: up, sideways, and down, and some of the factors I believe are within those scenarios. In my view, basically, I think right now, um, the first path, i.e., going back and just chugging along and going all the way up, resuming as though nothing has happened, I think that has the lowest probability, in my view. Okay, meaning to say, if I were to assign a probability, that probably is about 10% probability, maximum 20% probability of happening. Okay. The second view of markets moving sideways and third view of market moving down, I think that has a more equal probability of happening. I don't think we are out of the woods yet to say that markets are not coming down. I think we're still very close to that support line, and I think it's too early to cork the champagne and such. So even I would even say there's still a 40% chance of sideways and down markets happening, and a 20% chance of market going up, or even a 10% chance of market going up, and then 45. Okay, so I'm a bit cautious. I won't celebrate too fast or too soon, but at the same time, I think it's not. We shouldn't be afraid. We just should be prepared. Whether the market's going sideways or down, I think we can't control the market, but what we can do is always be prepared and not be overexposed, and to invest based on our risk profile and such. And I think everything will be fine if we follow those rules. What I want to share with you over the next couple of slides is just a few snippets on certain viewpoints which I have. And I think this is, again, you can tie it back to some of the things that I mentioned, but it could be separate, so to say. Okay, number one, and maybe these things will be coming up in the Q&A, but number one is about commodities. So there'll be a lot of talk about commodities. Commodities have run up a lot and such. What we're telling our clients is, yes, commodities have run up. We've managed to make some good gains there and such, but you must remember that commodities are not like typical shares. Commodities are very cyclical and supply and demand driven. It's very much like, if you look at this oil chart itself, you find that oil doesn't stay above 100 permanently. it goes above 100, stays there for a couple of months, even a couple 1 year and such. And in this particular case, quite long. But eventually it comes off. Why? Because as oil prices are high, what happens is producers then start to produce more. They may take some time to find new discoveries. Discoveries may take some time to come online. They may have some arguments as to when to release supplies like OPEC and such, but eventually it comes online and then it starts to push oil prices down. So it is really something which is cyclical in nature, unlike stocks. Stocks, you don't really, you talk about demand and supply, but you don't see stocks moving in a cyclical manner. It tends to trend higher and higher, although it's not in a straight line. Okay, so I think if people were to suggest, and I've seen suggestion that oil prices may go to 200 and such, potentially yes, but in my view, are quite unlikely, because again, it will just attract people to, or oil producers to produce more and to release supplies and such. Bonds itself, I think we're entering into an environment which is going to be very tricky for bonds. We must remember that not only are we having high inflation, but this world that we live in today is highly indebted. It's the amount of debt that has been created over the past decade is humongous. I think globally, we have the largest amount of debt ever in history, and then this really is a toxic mix for bonds, in my view. So really, as rates go up, as the economy slows, we've already seen some bond blowouts in China and such, and in certain countries also. So this is really something. If you're a bond holder, you really need to assess, where do I go, what do I do. Here, what I've tried to do is, this is the federal fund rates, effective fund rates. Okay, these are the dotted lines carve out periods where we saw large increase in the so-called Fed fund rates, and this is what really the Federal Reserve wants to do, if potentially they can, is to raise rates pretty fast. What I'm going to do is I'm going to maintain this red line here. That means showing you the so-called periods of time where the interest rates increase very sharply in these boxes here. And behind it, basically, is within the bond market, which segment of the bond markets did well during those periods. Okay, so if you can see during 2004, 2005, 2006, basically emerging market bonds did pretty okay. There's a long treasury here, there's a high yield here. Yeah, in 2010, 2016, 17, and 18, when rates went up, again, we got high yield, we got some emerging market bonds, we got long. So there are certain places in the bond segment where you can run and hide if interest rates start to move up very, very high. Moving on to the equity segment, very briefly, we used to be very traditional in allocating our assets, our equity allocations, very geographical in nature. US, Europe, emerging markets, and such. We've changed our thinking. We are now actually more akin to allocating based on teams. And why? Because we believe the next few decades will be dominated by teams, sectoral teams. And some of these sectoral teams are like decarbonization, climate change, digitization, even the commodity cycle can be tied into decarbonization. And so these are some of the teams which we feel are going to drive profits and the alpha over the next couple of decades. In fact, not even years, but decades. I mean, you take, for example, decarbonization. Yes, we've seen sell-offs in some of these solar companies, EV companies, Tesla and such, but we just cannot run away from the fact that there are targets being set globally for climate change, whether it's the Kyoto Accord or whether it's whatever, Paris Accord and whatever. That means by 2040, 2050 in Singapore, 2040, I believe, there are no more carbon emission cars. Many countries, it's either 2030, 2040, 2050, and so on and so forth. What you see is trillions of dollars being pumped into, because in order to decarbonize the economy, you need to actually change a lot of the infrastructure. And to change the infrastructure itself, you need money. I mean, just talk about EV itself, electric vehicles. By the time 2030, 2040, when Singapore changes from petrol to electric, we will need all the charging stations, and so on and so forth. So that is actually an investment. Okay, so this is really, it's going to be driven by both public and private sector involvement. And so this is a trend which is just will not reverse. It's a question of what level do you get in, what attractive prices do you get in. Okay, The other one is a digital asset class, and really this is really very exciting, and I'm very excited about it. You know, I think the last time we as investors experienced the birth of a totally new asset class, we've not seen it since the 1970s, and that was gold. Okay, why do I say that? For those of you who've studied the history of gold, you know that before 1970, before the collapse of Bretton Woods, gold was pegged to the US dollar at $35 an ounce. Okay, and back then, prior to that, you couldn't own gold. You couldn't put it in your portfolio because it was illegal to put gold in your portfolio. So gold wasn't an asset class prior to 1971. Okay, but after the collapse of Bretton Woods, again, monetary policy became floating currencies. Gold was allowed to then depeg itself from the US dollar and allowed to float. It took a bit of time, but people were starting to then accept gold as an asset class, a new asset class, and we saw gold starting to move higher. And eventually the exponential move here. So this was really the birth of a new asset class. And this is how digital assets are going to move, because digital assets are a new asset class altogether. I know people worry when they talk about cryptocurrencies, you see the word cryptocurrencies and such. I think if you want to think about it, please don't think about it with one brush. You must understand that cryptocurrencies currently, I think there are more than 8,000. This slide is a bit, it's not even old, it's like 2 months old, but things are just growing so far. They probably got more than 10,000 cryptocurrencies now. But cryptocurrencies can actually be divided into different kind of currencies with, or different type of cryptos with different utilities. There are certain cryptos which are exchange tokens, certain which are utility tokens, certain which are DeFi, smart contract, digital currencies, so on and so forth. Of course, there are some which are of very little use, like your Dogecoin, your Shiba Inu and stuff. Okay, to keep that aside, those are giving cryptos not a good name because it's speculative in nature. But there are many of them which actually have very, very good use. Okay, we've got tokens now that allow for transfers. We've got central banks also picking up the whole thing with central bank digital currencies. We've got teams issuing tokens because they are now tokenizing their fan base and so. But I think the very clearly one of the key things that me as a financial guy, when I see DBS, when I see the European Investment Bank, which is the investment bank for the European Union, issuing bonds which are digital in nature, which are using a particular network called, or the blockchain called Ethereum. This is mind-boggling because, in that means probably in the next 10, 15 years, potentially all bonds that are being issued, the majority of bonds that are being issued will be issued on a blockchain. We're no longer going to see bonds being issued in a traditional way, but and in a digital format. It's just so much cheaper, so much faster, so much more efficient, so much more safer, and so on and so forth. So this is really happening. So this is part of that crypto which people forget, and they always see volatility, price, hacking and such, and they focus on that. Okay. So always remember, behind a coin, if there's a utility behind it, see what the utility is. This particular coin, Cardano, for example, behind the coin itself is a company who has a project, who goes into, for example, in this particular case, Ethiopia, who actually has given digital identities to all the students there. I think actually a million over students. Okay. So each student has a digital identity where his or her marks are being put into the digital identity. The policymakers are able to differentiate who's doing well, who needs more tuition, who can be sent for special classes to hone their skills, and so on and so forth. Marks cannot be changed. No, you can't bribe a teacher to change the marks. So a deserving student will be given the awards and stuff. All of this really is making a huge amount of progress, and sometimes we don't see it because these things just don't come out in on the front page of newspapers and such. All we see is, oh, crypto, oh, this particular coin, oh, it's so volatile. But these really are these real utilities that are going behind certain, not all, but certain cryptos, which I think is going to be the driving blocks behind the adoption of cryptocurrencies. Okay. And remember, this is where we are currently in terms of crypto. So there's still a long way to go. The adoption rate for cryptos is going to skyrocket in the year. And this is why this is one of the themes that we have latched on when getting our clients to go on to. Okay. And lastly, alternatives. For those of you who qualify, because alternatives typically are meant generally for accredited investors, it's really one segment which increasingly is becoming more available. Used to be just for this ultra high net worth for institutions, but this is now becoming more and more available to high net worth individuals. Unfortunately, not so much for retail, but for high net worth. So if you qualify, you have $1 million in liquid assets, you can actually venture into some of these investments. And this is necessary because that's where you really find what we call non-market correlated investments. In this kind of volatile markets, you really want to plug in some investments which are non-correlated to your traditional markets like stock and bonds. Yeah. I'll end with just giving you a very kind of a sweetener to tell you like what this thing means. In the past couple of months, as you can see, the stock markets have been quite volatile, down, up, and then early this year was down because of because of Ukraine and stuff. This I've not written the name, but this is really an alternative investment, which is private equity alternative investment. This is an alternative investment, which is a fund of funds, and as you can see, they basically they're non-correlated. When the markets fall, they just remain as they are and they just continue to do so. This guy here has an average return of 10-15% a year. This guy here has average return about 7 to 12% a year. And they just continue to do their stuff regardless of where market's going. And that's something which I think investors increasingly should try and put into their portfolios. Okay. All right. In summary, just looking at time, 52 minutes, and I think the delay also probably has brought it to about an hour, so I do apologize. I think it's going to be a challenging period in my view. I think the so-called easy buy on dip strategy, which we have been adopting for the past 10 years, has come to an end. And I think the evidence is basically structurally things have changed. Quantitative easing is going to give way to quantitative tightening. Low interest rates are going to give way to higher interest rates. And there are geopolitical changes which we may not necessarily understand the consequences of. People talk about globalization now being destroyed or being now dismantled. It's not going to be easy anymore to get cheap goods from China because of trade wars, because of barriers, of sanctions, and so on. So all of this is really creating an environment where it's totally different from what we saw the past 10 years. Yeah. So it may be okay that we are entering into an environment where not losing money is making money. I like to use this one whereby it's not always about making money. There are certain periods of time where guarding your capital, getting returns of 5, 6, 7% is considered to be very good. Gone are the days where you look for double-digit returns on the stock market. Not say gone, but you just have to accept there are certain cyclical times where this is really not the period where we're trying to make double digits is the key thing. Yeah, so getting high single digits probably is great in a sense. Okay, so but there will still be opportunities. So I think you just have to be nimble and aware of the opportunities. All right, so I'm done here. I will end and I will just pass it back to Richard, and I think Kenny will take over, and I'll see you guys again if you have questions later on during the Q&A.
Thank you so much, Sunny. Wow, that was certainly a helicopter view of what's happening in the world. Not easy to monitor so many things, huh?
Yeah, true.
Yeah, wow. So thanks for summarizing it for us today. And now let us continue with our second speaker for tonight, Mr. Kenny Low, who will share with us about portfolio construction as well as how to navigate, whether he has any further insights and input regarding what Sunny have shared. Then following that will be the Q&A. So if you have any questions, please type them into the chat box you see on the screen if you're using a desktop computer, or if you're using a mobile computer, please, mobile devices, then please scroll up or down to look for the chat box and type in the questions there. At the end of Kenny's sharing, I will then go through the questions and post to both of them to answer. So Kenny, please.
All right.
Still sharing? Yep, not appearing yet.
Not appearing.
Yeah,
Still
well, let's
loading.
wait for another 20 to 30 seconds.
Right. You can hear me, right?
Yes, can hear
Okay.
and see you, no problem.
Yeah, you just let me know once you see the slide.
Yep, it said loading error. Maybe you try again.
Okay.
Are you using Chrome?
Yes, I'm using Chrome.
Okay, can. Saw it already.
You saw it already?
Yep.
Okay, it's on a full screen now.
full screen. Yes.
Yes, okay, full screen now. All right. So I think that for the past 1 hour, probably whatever Sunny has shared, I think quite a number of you probably confused because we have just too much information. So I'll be sharing that what to do during this confusing situation, and also how to navigate through with all this kind of uncertainty. All right. So first thing first, we cannot control those external events. All right, you can see that the interest rate hike, the war, the hyperinflation, the COVID, those things we cannot control. So if we are not able to control, no point we are on control, we are going to worry about that. So my strategy and also in advising my client and also for myself is basically I control what I can control to build a diversified portfolio which can navigate through for all this kind of uncertainty. So I will share with you some of the things to consider before we are building our own portfolio. Whether you want to build it for yourself, for your parents, for your spouse, okay, you may need to consider all these points. Because I also, after so many years, I also start to realize that many of us as a retail investor, right, we just invest for the sake of investing, or we are buying an insurance just for buying the insurance without going through the proper planning. So I will share with you what are the key things to consider in the planning phase. This one will be very helpful in your investment portfolio planning. First of all, you have to understand the investment or objective, whether you want to invest to preserve all your capital for your next generation, or you want to invest to generate passive income maybe 20 years later for your retirement, or you invest for the short term, maybe 5 years to 10 years for capital gains so that you can buy a house, buy a car in the medium term period, or you just want to optimize the return. As long as your investment able to beat the inflation, able to have a higher return compared to bank interest rate, and then you may need to look for those investment which can really meet your objective. So defining the investment objective is the most important thing you have to do before you start thinking about investing. Second step is the risk profile. You really need to understand yourself how much risk you can take and how much volatility you can take into your portfolio. Your risk profile can be very aggressive. You don't mind to park your money there, and you are able to look at your paper loss of 30% in one day. Okay, or you are totally not able to take that kind of volatility. When you see a 10% drop in the portfolio, you start to chicken out, you start to worry. So you probably is those conservative investor. And then the next thing is the time horizon. Are you investing for long term or are you investing for short term? There's only actually when you start to, if okay, there are three criteria. There are three criteria that very high probability you won't make money in the long term, right? If you have enough time, okay, that means that you have 10 years time horizon, 20 years time horizon, and beside time, you also have those excess money you do not need to use for the short term or medium term. Plus, you have a diversified portfolio. Over the long term, I'm pretty sure that you're going to make money. So time horizon, you determine whether you are able to do well in your investment. So is this criteria is very, very important when you are constructing your portfolio. Okay, and the number fourth is your current financial situation, right? Whether you have set aside enough emergency fund, whether you have a side a liability you have to fulfill in the short term or medium term, or whether your job is secure, right? If you think that your job is not secure in the short term, if you lose your job, you are not able to really pay off your expense or not able to pay off a liability, whatever investment portfolio you build out, eventually you have to liquidate it. So job security and your current financial situation also play a part into your investment portfolio. Number fifth, you'll be your future consideration. Whether you are planning for a marriage, or whether you are planning for have a children, or you need to take care of elderly parents, because as our generation, most our parents that do not have an insurance, and when they are aging, the medical expenses is coming out, and as children, we have to support all these kind of medical expenses for our parents, right? And or you want to buy a car, or some of you maybe want to invest and you just want to make sure you are able to pass down all your estate to the next generation. Work commitment. after doing all these things, do you have time to really do homework during the weekend or monitor the market? How much time can you afford to set aside just to your investing? Investing is not just you buy and after that close your eye and the return you automatically come. You have to do a lot of homework. You have to do annual portfolio rebalancing or do a switching as and when needed. So there are some work need to be done. And other priority, maybe at the end of the day, you love investing, but you don't have passion or you don't have a discipline to do all the homework, to do the research, to spend maybe 5 hours a day or 5 hours per week to really monitor the market. So those are the things you probably have to consider. Okay, you prefer or you prefer to go holiday to really pursue your interest and go honeymoon and those things. You don't really want to spend your time to really sitting in front of computer doing a research. So those are the other priorities that you may need to consider. And after you have done your initial planning, the next step is to identify the suitable asset class for you. There are many asset class out there, right? There are different type of instrument that really can fulfill our investment objective. Okay, we can have the higher risk, higher return that kind of asset classes, for example, digital currency, or you can look for those where safe that kind of instrument, lower risk, lower return, for example, cash saving, maybe endowment or some of the annuity plan, right? In between, you have a risk, you have a real estate, you have an equity, so on and so forth. So once you identify your risk profile and choose the asset class you are comfortable in, after you have identified your asset class, then the next step is to choose the available solution. Okay, this slide you show that all the available solution a financial alliance and also myself can offer to our client. Okay, for example, in this case, just some Sani has mentioned about a digital asset. We have a cryptocurrency fund or a digital asset fund, which is applicable for AI only. So this asset class offer the higher risk and higher return. Later, I will show you how high the return can be. But at the same time, the volatility is also very high. And you can use your cash to invest in this kind of digital asset class. And the second one, slightly higher risk than the common equity, but lesser risk than a digital asset would be the alternative investment. We have a private equity fund. We also have a hedge fund, and also we have a structured note. Okay, all this investment can only use a cash to invest. The third group will be the equity. We have the stock managed account or individual stocks, and we also can access the equity to the sector ETF and also the unit trust. And investor can consider to use cash or SRS or CPFOA to invest in this kind of equity. It depends on where your resources come from. Okay. Then the other group with the risk, right? Risk, the main objective of risk is for the dividend payout. We can access to risk by buying the individual risk. Or if you do not have time to do homework to monitor market, you can engage your advisor and use the managed account to help you to invest, or go with ETF and also unit trust. And you can use cash, SRS, CPF, OA to invest also. Then for the lesser type of instrument is a bond, right? Same thing, managed account. You can also invest directly to the corporate bond or ETF or unit trust. And for those capital protected product, you just do not want to have the market volatility. You just want to have whatever thing you invest at the end of the day, 20 years later, you just want to have your capital come back to you. But at the same time, you don't mind to have a very low that kind of return. You can look at a variable annuity. Variable annuity, you have the capital protector. At the same time, they also offer some upside potential, right? This is different compared to the endowment. Endowment don't give you the upside potential, but at least the capital is protected. Or you can look at the fixed payout by the insurance plan. So there are many type of investment opportunity and also asset class out there for you to really build a diversified portfolio. So once you identify what are the asset class and solution you want, basically for if you want to DIY yourself, there are so many fund manager out there for you to choose from. So as a DIY investor, you have to go and read each of the fund fact sheet to understand the investment mandate, to listen to the fund manager or portfolio manager how to devise their investment strategy, how they manage a risk. That's why there are a lot of work for you to really do before you can select the right fund manager. Okay, fund manager selection is very, very crucial to make sure your investment is successful. So as an independent advisor, we are able to offer this kind of service to help you to do all the homework. Basically, Financial Alliance have an internal research team. We have already shortlisted some of the good fund manager with a good track record and with the associate risk profile to really recommend to our client. Okay, this is one of the example on the asset allocation. One, you have decide what type of asset class you want to put into your portfolio. In this example, for example, this client has a portfolio size of 1 million. The objective is to have an aggressive growth in a capital. So this portfolio consider high risk and also higher return that kind of portfolio. And these are the allocation. For example, the private equity currently which is available at Financial Alliance, you give you average about 15% per annum return, right? In this case, you are just doing some 20% allocation to this private equity, 20% to a sector ETF, REIT 30%, equity UT 20%, digital asset 10%. And all in all, you can see that the weighted return for this diversified portfolio itself is close to 11%. If you use the rule of 72, all right, with that kind of 11% per annual return, your capital can grow from 1 million to 2 million in just 6.5 years. Okay, so by adjusting this allocation, you can optimize your return accordingly. At the same time, that this portfolio you offer you the diversification, because one of the very important rule is don't put all your asset into one asset class. Don't put everything into one basket, because in this volatile environment, we cannot control the external factor. So it is better to really have a very, very diversified portfolio to really manage our risk. Okay, these are some of the performance of the accredited investor fund that currently available, which is a non-market correlated alternative investment. Sani has shown you a green snapshot just now. So this one is a digital asset. And you can see from here, this digital asset has been launched about 2.5 years ago. And in 2020, the annual return is 46.6%. And 2021 is 80%. So as part of the portfolio diversification, and also if investor want to ride on the initial infant state of the digital asset, you may want to consider to allocate certain percentage of your portfolio into the digital asset. Okay, beside your maybe conservative or traditional that kind of portfolio. Okay, this will really help you to really enhance your growth much more faster. And the other alternative investment that currently available is one of the healthcare fund, private equity. Right, you can see from this chart itself, since the inception in 2014, is really growing in one straight line. Okay, and this is non-market traded. Basically, the valuation is from a net asset value of the business itself. We are investing into the business directly. So as long as the business is doing well, they are able to continue generate cash flow. They increase the strengthen the balance sheet. The net asset value will continue to grow. And this alternate investment will give you about 15% per annum return. Okay, the other way to really tap on some of the thematic investing, just now Sani has mentioned, decarbonization, EV, so-called technology disruption, commodity itself. You also can consider to build a diversified portfolio through the ETF or through the balance fund. In this case, these are pretty diversified portfolio. You have some balance fund there. We have some high yield bond. We have some fixed income in the portfolio itself, and we also have some allocation in the gold miners to really hedge the inflation and also a portfolio volatility. We have some technology sector. We have a China sector. We also have a global climate change team, and also have a global healthcare equity fund. So by constructing this portfolio itself, I did a back test on this diversified portfolio. The annualized return is about 11% for the past 10 years. Then the second group of investor probably would like to focus into the dividend income portfolio. I believe that many of you that you want to focus on dividend portfolio. So I just give you as an example, same thing. The portfolio size is about 1 million. The objective is for the dividend payout. Okay. What you can do is you can allocate 30% to REITs. At the present moment, REIT can easily give you a 5% dividend per annum, right? The dividend stock you give you about 4.5%. Bond with a mixture of a investment grade bond and also high yield bond or emerging market bond. Conservatively, very, very conservative, you can get 3.5%, right? And you also can use the insurance retirement income so that you have a fixed payout that give you about 2%. And the other one, you can also construct a multi-asset income fund, give you about 4.5%. So by adjusting all this kind of allocation, you can really optimize the return. In this example, the weighted return for this portfolio is 3.8%. Definitely can be can beat the long-term inflation rate of about 3%, right? That is the key objective. So this portfolio will give you a consistent passive income payout and with low volatility. Okay, so me and Sani, we are in the investment advisory. So with the Sani macro strategy and also with my past experience working as a sourcing director and also managing a factory, I know how the factory run. I know what are the issue of the business every day facing in terms of the inflation, in terms of supply chain disruption. I really know insight in that area. That also helped me to really have a better assessment on what is happening on the ground and also help me to in terms of the stock selection. So me and Sani, we have been a close buddy for 30 years. We know each other since our uni day in NTU. We stay in the same hall. We stay in the we don't stay in the same room. Okay, we are in the same football team. All right. Basically, we were in the university team. We are representing the NTU, and also we are representing a hall. Basically, I'm pretty close with Sani. Every time we go for training and also dinner, lunch, most of the time we will together. Then after the university, he also invite me to join the social soccer, and I play as a goalkeeper and he play as a defender. So we always cover each other, and from them we really. Our key objective when it comes to investment, we always use risk management as a top priority because in nature, we play as a defender and also goalkeeping. All right. And now I joined him in Financial Alliance. At the same time, it's also my pleasure and also honor to be on stage with him conducting the same webinar. So both of us have a very regular discussion on the market condition itself. We sometimes we talk about the scam, right? Sometimes I spotted some of the potential scam on the internet itself. I share with him. Then after we start to analyze case, and quite often a time that after 1 year later, then this proven is a scam, right? At the same time, before he started to specialize in cryptocurrency, we discussed about cryptocurrency before. Last time, Sani was not really favored in the cryptocurrency, but now he's an expert in cryptocurrency. So for us, the information exchange is very important to really help us to navigate through and also react fast in this uncertain environment. Okay, so as an advisor, how can the advisor help our client to really navigate through difficult period? I would want to share this ABCDE model. So any of you, if you decided or thinking of the engaging advisor to really help you, to handhold you, to help your investment planning, you probably have to look at these 5 things, ABCDE. A stands for asset allocation and rebalancing. Your advisor should be able to really provide you the multi-asset kind of approach and also explain each of the pro and con of asset class. Okay, so that you are able to choose the asset class which is suitable to you and also give you advice how to do the rebalancing. The second thing will be the behavioral coaching. This is very, very important. If you think that during the recent period, you have a COVID, you have a war, you have a hyperinflation and also rising interest rate environment, and the market has been very volatile for the past few months, and some of you really panic and do not know what to do, having a good advisor really can help you to really calm your whole thing down. All right. I have done this so-called behavioral coaching during this period. There are many of my clients, they really feel very uncertain on the market, and I explain to them what is the rationale behind, and I also show them a chart and how the market can react after the war, and especially on the REIT itself. I also show the past rate hike, how this rate hike affect the REIT sector as a whole. So this behavioral coaching is necessary throughout your investment journey. Okay, C. Okay, there is no one size fit all that kind of investment. So my investment portfolio, you can't copy it because the risk profile is different, the preference is different. So it is very important you don't copy other people investment strategy or copy other investment portfolio, because it may not suitable to you. So very important, you have to understand what is your financial objective personally, and what is your risk profile, what is your investment horizon, and you need to make sure you customize your investment portfolio to really suitable your needs. D is to make sure you have a diversified portfolio with non-market correlated that kind of asset classes. This is very important, because when the market crash, if your asset class are closely correlated to each other, you can't sleep well, because everything you fall together. But on the other hand, vice versa, if the market have a bull run, then all your asset class will be going up together. So if you really do not want to have that kind of volatility, you just want to have a sleep well portfolio, make sure you diversify it properly and include some of the non-market correlated that kind of asset class into your investment portfolio. Okay, E. Basically, very frequently, me and Sani also conduct courses and also conduct a market outlook, and the education is very important, and we are practitioner, right? We don't talk about theory, we use facts, we use the market behavior, we use chart to really share with our investor or our client on in order to manage our portfolio. So based on our extensive research, I think that we can really value add to our client. All right, so this would be my last slide, and if you need any help or interested in any one of the service, for example, REIT advisory, if you're interested in investing in REIT but don't know how to start, or do not have time to really construct a portfolio or monitor a portfolio, okay, you can look for me, right? This is my email, and this is my profile. All right, you can do a QR code scan, you can go to my profile to take a look. And if you want to have a more holistic kind of investment planning, look at the total portfolio and advise you what kind of asset class you should really include in your portfolio, you can also approach me. And if you are planning for retirement planning, you want to have a dividend payout that kind of portfolio, but you do not want to just overly concentrate into one asset class, you want a more diversified approach with some insurance or some dividend stock or some REIT, you also can look for me. And if you have bought a lot of insurance and every year you keep paying the premium, but you do not know what you're paying for, and you also have a concern whether the insurance portfolio currently you're having now, whether it's suitable to you, you can also engage me so that I can help you to do the insurance portfolio audit. Okay, I'll tell you which one to keep, which one to sell, or which one to really restructure. Okay, lastly, I'm also offer the estate and also business succession planning. If you are planning to preserve a capital and for your future business succession, okay, we also can discuss about that. All right. So after you scan your QR code, you will be directed to this profile page. And if you want to contact me, okay, you just come to this button on the top, contact me. My mobile phone is there. You just need to click it on, then you can reach me to my mobile. You also can reach me through my email. Okay, it's quite easy to reach me. All right, I think that's all. I will hand over back to Richard for hosting the Q&A.
All right, thank you, Kenny, for the very comprehensive overview of what a person can do and to manage their own diversified portfolio, the big framework. So let me now see what are the questions that our attendees have. Now, if you are watching us in the webinar room, please type your question into the chat box you see on the bottom right of the screen. or if you're watching us on the mobile device, then please type into the chat box, but you need to scroll up or down to look for the chat box. And if you're watching us on YouTube Live, then I would suggest that you come inside the webinar room so that you can uh, type in your questions. All right. So let us now see what are the questions. So while you're typing the questions, let me take over the screen for a while. Okay, so please let's give the attendees about another 10 seconds to type out the questions. I'm also monitoring my screen sharing to see that it's loading or not. All right, I can see a number of you typing. So let's give you another 10 seconds or so to type.
Yeah, Richard.
Okay, yes, yes. Now, while you're still typing the questions, I'll just like to voice my opinion about this DIY and DFY approach to our wealth, right? Our wealth targets, right? So what Kenny has shared, and oftentimes many of us are doing things DIY. That means we do it yourself. That's like us driving a car to get us from where we are to where we want to be. Absolutely all right with that. All right. So we can still get to our destination. Now, the alternative is to do the DFY approach, which is done for you. And that is the passive approach. And that is just simply by being a passenger. Of course, we need a driver, right? We need to pay someone to be the driver. So the service provider will ensure that will bring us from where we are to where we want to be. So there are many books and courses and YouTube videos out there that can help us to become a better DIY investor. So by all means, do that if you have the time, you have the experience or the interest to do it. But if you do not have the time, the interest or the experience to do it, perhaps while you are still learning how to DIY, you can also consider DFY. And that's where expert advisor like Kenny, who is MAS licensed, can come in. So maybe Kenny, can I check with you? Must clients be in Singapore to engage your services? Because we do have audience from overseas. So can they also engage your services if they are overseas?
Yes, but there is a special process we need to do for the onboarding. So
Okay,
the
no
short
problem.
answer is yes, but there are some special arrangement.
Right. So at least they can still reach out to you to see what kinds of procedures they need to go through. So if you're watching this video outside of Singapore and you are interested in Singapore REITs or the services that Kenny can provide, so please feel free to reach out to him. So let me see what questions we have now. Okay. Okay, Charles is asking, I think this question would be for Sunny. Charles is
Mm-hmm.
asking, if the company keep buying back their shares, does this
Mm-hmm.
leads to sustainable price increase of the stock?
Yes, the answer is yes, and I think that's that was what the Deutsche Bank chart was showing. Basically, during the period of 2009 all the way to 2019, the net buyer in the US stock market was basically non financial or non bank corporations buying back their shares. So they were the ones effectively pushing the stock market up during that period. So yes, you're correct.
Right. Charles, I hope that answers your question. Now, the next question is from Yin Tak. It's for Sunny. Is
Mm-hmm.
there a historical relationship between credit impulse and Fed balance sheet reduction?
Not that I know of. I mean, I've not come across. The one I've come across is the one I presented, where people tend to put together credit impulse and PMI, credit impulse and treasury yields. but not with the Fed, not with the Fed balance sheet itself. I think the Fed balance sheet is less um, is less cyclical in nature, or rather, it's less connected to the economy per se. It's a bit one way because Fed balance sheet is also something quite recent. We didn't really see Fed balance sheet prior to 2009, or rather quantitative easing. It was only in Japan and such. So it's quite a new so-called new what do you call new weapon in the arsenal of what the Fed has. So no, I don't think there is this so-called relationship at this point.
Right. Thank you, Sunny. Yentak, I hope that answers your question. The next question is from Henry.
Mm-hmm.
Referring to the chart comparing household income and GDP, do
Household
you
wealth.
not
Mm-hmm.
think that the wider the gap, the
Mm-hmm.
less likely they will ever converge, as no
Mm-hmm.
politician can
Mm-hmm.
survive the fury of voters whose
Yeah,
assets are decimated and the central
yeah,
bank therefore be pressured to act?
yeah. It's a good question, and I think the answer to that is basically um, the periods of time where you see a convergence or so-called a reset are periods of inflation. Okay, so inflations are there. It, not talking inflation, recession. My apologies. I'm getting old. Recession. Recessions are periods of time where markets and economies reset. When it gets too far to one side, recessions kick in because there has been just exuberance in terms of asset prices and such. And that's really the key thing about recessions. Recessions are there to reset the economy. Um, you would say that if the central bank is independent, of course they will try and to stop or cushion that recession. Um, it is in the interest of the economy not to see what we call a sharp decline. So while it's true that politicians themselves would not want to see it, but it's also just natural for a central bank and government to come in with fiscal and monetary policy to try and stop that decline. What I think um, we have seen, and there is this debate, is that over this past decade, because the central bank is now equipped with a very strong weapon, which is quantitative easing, they have effectively erased out any significant downside. Therefore, they have not allowed the markets and the economy to reset as they traditionally should. Because, recessions are there to get rid of the excesses. And if you don't allow a recession to take place, and you come in and prevent it, what you're doing is you're just keeping all this build up in the pipeline. And this is what we're seeing: the so-called huge growing divergence between the real economy and wealth and your net wealth. So when the pain comes, um, yes, I think they will try to stop not stop the pain, but cushion the pain. But I think history has shown that the market is bigger than the Federal Reserve or any government. They couldn't stop the pain in '08. They couldn't stop the pain in 2000. And I think there's no reason why we think they can stop the pain if this whole thing unravels. So it will be quite bad politically, but that's the price you pay for keeping this, keeping the punch bowl and keeping the music playing for well extended period of time. Yeah.
Right. Thanks for the comprehensive answer, Sunny. Henry, I hope that answers your question. Now, the next question comes from Connie. Connie is asking, what if I want all these wealth preservation, passive income, capital gain, and optimized return? What should I do?
That one, Kenny answer.
Kenny.
Yeah.
In this world, like we are playing soccer, Sunny also want to score goal, and no, it's like impossible because each of the objective, the risk profile is different, And if you want to have all things, I would suggest that you set up a different portfolio for different objective. For example, if you just want to have some safe instrument to really optimize the return, but you do not have one on volatility, then you just set up, maybe allocate 20% of portfolio just to play that part. And the other portion, if you want to have maximum growth, you want to have 20% that kind of return or 10% that kind of return, that was super aggressive, then you just maybe set aside 10 to 20% just to tap on the aggressive growth. And the other portion, if you want to have some passive income portfolio, maybe if you're planning for retirement, you need to have some income replacement. Maybe you allocate 50% just for dividend generation income. So once you set up all this kind of bucket of the portfolio accordingly, you know exactly when there are certain market conditions change, you know which one to run and which one to keep. Right? For example, to invest to optimize the return, basically you just want to beat the bank interest rate, then you don't run. But for your most aggressive portfolio, if something changed, you have to run. That means you have to liquidate everything, park cash. You have to do that. Right.
Right. Wow.
Yeah.
Okay,
Right.
Connie, I hope you can have your cake and eat it. And if you need help, please contact Kenny. If you can do it yourself, then hopefully the bucket concept that Kenny has shared can be a tip of where you can start.
Yeah.
Okay,
If I
thanks,
may
Kenny. Sure.
just add, yeah, I think it's very important. I think this is something which a lot of investors investors tend to lump everything in one bucket. When they see risks, they will take away or take out or de-risk, like get out of the market. Whether this thing is meant for long term, whether it's meant for short term, they'll just take everything out, and then because they're afraid. But what Kenny said is very true. Different objectives tend to be served by different portfolios, and different portfolios react differently to the same event. I give you one good example. I gave a talk once in Malaysia. We were at that point a little bit bearish on the markets, and we were saying, markets could actually fall. And this lady approached me after that, and asked me, in that case, should I withdraw and sell my shares? I said, what shares are you holding? And at that point, she mentioned that I'm holding on to Public Bank. And I said, how long have you held on to this share? She said about 20 years. And I said, okay. Why are you holding on to it for so long? Oh, because it gives me dividends of, I think, back then was about 7-8% dividends, and I think it still continues to give quite high dividends. So I said, why? In that case, why do you want to sell it? Because if you're there for the dividends and it's giving you dividends every single year, and you've kind of held it because of the dividends, and you've sat through the 2000, the 1997 crisis, and for the past 20 years we've gone through so many crises, you've continued to hang on to it, not because you were worried not because of the capital's part of it, but because of the so-called dividend part of it. As long as you got your 7-8%, you were happy. So you kind of the capital was secondary, so to say. So you can see from here that that same event, i.e., worried about market coming off, but reaction is totally different. A person who is a trader would probably get out of the market, or have short-term speculative positions would get out. A person who's a dividend in there for the dividend would stay in, because his or her focus is just on that dividend. It's not so much on capital movements, because over time capital movements tend to offset one another.
Right. Thank you, Sunny, for your additional insights. Okay, Connie, I hope that additional insight is helpful to you too. Okay, let's move on to the next question. It's from Yuan Tak again. So he says, "Hi Kenny, as a retiree with a long-term dividend income objective, how many percent should we allocate to PBSA as part of a diversified REITs portfolio, assuming that we already have 75% industrial, 25% office and retail in our REITs portfolio?"
Okay. Anyway, there is no PBSA. PBSA is a purpose-built student accommodation. For those who don't know, we don't have any PBSA REIT in Singapore at the present moment. But there is a speculation, a Maple Tree investment. You're going to launch a PBSA REIT this year or next year. All right, that's a speculation only. So currently, the only REIT which hold the PBSA from US is a Ascott Resident Trust. The allocation is, I think, close to about 20% only. So if you want to invest in this PBSS sector, the only REIT that can give you that kind of exposure is the Ascott Resident Trust. But just bear in mind that Ascott Resident Trust in the hospitality sector, If you want to have a less volatile, that kind of dividend payout, less seasonal, hospitality REIT may not provide you that kind of perspective. So the answer is yes or no. If you really look for specific REIT, just for this one, at the present moment, it's not available.
Right. Okay, Yuan Tak, I hope that answers the question. And like what Kenny says, keep a lookout for PBSA REIT that may be launching sometime in the near future. All right. So let's move on. The next question comes from Steve. He's asking what's the realistic time horizon for private equity to gain meaningful return, and what would be the drawdown percentage wise?
Yeah, Sunny, I can answer, but you are the one.
Yeah. Well, private equity is a name for a particular segment of the market. So it really depends on what type of private equity it is. There are certain private equities which are the traditional type where it's locked in for 3 years because why? The mandate is to get your money, put it into a so-called maybe a pre-IPO or project, and these projects only come to fruition in 3 years' time, 5 years' time. So the fund manager needs to make sure that you don't kacau him over the next 3-5 years, because it really takes time for that investment to come to fruition. But there are also other private equities which are investing. So those will take some time. Okay, so 3 years, 5 years, lock in, can't get your money. There are some private equities which are investing in existing companies, for example. So those ones are companies which are already running, companies which are already producing revenue and cash flow, and therefore it may allow you to actually withdraw some of your profits along the way and so on. Okay. Only thing is most of these private equity funds, although they allow you to withdraw, and we have one of them, they do put in what we call a step down penalty. If you withdraw in the first year, you get a penalty of 5%, second year 4%, 3%. These penalties are not meant to hurt you, but it's meant really to avoid people using these private equity funds as short-term vehicles, because hey, this private equity is giving me 15%, is historically is giving 15% per annum. Why do I take something out? Why don't I take my fixed deposit out and put this for 1 year, and then I make 15%? It's equivalent to putting in fixed deposits for 15 years. But it's very disruptive for the fund manager because private equity is not meant to be something you go in and out in a single year. So these kind of penalties are inbuilt or built in, to avoid attracting the wrong type of people, not to penalize the people who are there really for the slightly longer run. Yeah. So different. It actually depends. The short answer to your question.
Right. Maybe you can give a idea of the range. Let's say the more maybe one particular profile of the PE fund, then what kind of return and drawdown that it gets, maybe the conservative type. And then on the other spectrum could be the more speculative one, the higher return aggressive one, and what would be the kind of return and the drawdown in percentage wise, so that and then the Steve
Yeah.
can project in between.
Oh, okay. So like for example, we have one private equity fund now, which is our flagship private equity fund. It invests in an existing business, which is ongoing, running, a very successful business. So every month it produces revenue and cash flow. On average, that provides a return historically of between 10 to 20% per annum. So that's an example of a private equity fund which gives continued cash flow, continued returns. Okay. We've seen private equity funds before, and we don't have it now, that basically are close-ended. You put in money, 3 years later, you get your money back. Those sometimes are, of course, higher risk, high return. Those you can get maybe 70, 80, even sometimes 1x, 2x your double your amount that you put in, triple your amount that you put in, but it comes with the risk. Because as we know, investing in projects can go wrong and so on and so forth. So those are the different characteristics of private equities. The really junior, just off the ground, relatively greenfield projects, and some of the other ones are the matured ones and so on. Yeah.
Right. So I guess from what Sunny has shared, Steve, is that private equity is a very big name. It's like REITs. Then within REITs, there is the residential, commercial, industrial, retail, and then the China focus type. So each subtype will have its own characteristics, right? So same thing with PE. PE will also have something like that. Am I correct, Sunny?
Yes,
So,
correct.
so depending on your risk profile and appetite and time horizon, then I guess then you can select the type of PE that meet your needs. So if you have access to that, then you can DIY yourself. Otherwise, you can approach Kenny for some chit chat about it. Right, Kenny? Anything to add on that?
The drawdown itself, right? The private equity fund currently available now. I think the maximum drawdown is only 1 month, right? 2%. Sunny, is it 1% or 2%?
Well, yeah. Um, because it's an ongoing business which produces returns every single month. There are certain months where cost exceeds revenue. Very rare. I think in the past 5 years, we've come across maybe just about 6 months out of those, like what, 60 months, which had slight negative returns. Most of them are just 0 point something percent. One of them was actually 1 or 2%, and that was because there was an increase in the minimum wage for that particular month, and that was instituted by the government, of course. So therefore, that month was just a -2% or -1 odd percent. Yeah, but it's kind of relatively predictable because ongoing businesses are quite predictable. Yeah.
Right. Okay. All right. Thank you. Thank you, Sunny and Kenny. Steve, I hope that answers your question. Okay. Next question comes from Mr. Chu. Mr. Chu is asking, what do you think is the direction of the US dollar moving forward?
Hmm. Okay. My view is basically short term. We could see dollar strength. Again, currencies are so hard to predict, but short-term dollar strength basically on the higher yields, higher rates. So you see a divergence in U.S. rates moving higher and widening compared to some other countries, emerging market currencies, and even some other G7 countries. So that actually benefits the dollar short term. Long term, because of the dismantling of some of the dollar trades, oil being paid in euros, oil being paid in Chinese yuan, and stuff like that, and people trying to move away from the dollar, I think we could be at the cups of de-dollarization, which is going to be longer term. It's not going to be easy to. It's not going to come like overnight. It's going to be a long-term trend, but I think it's happening already. Yeah.
Hmm. Okay, that's a bit worrisome. Right.
Well, it
So,
depends. You can if you're not in the dollar, don't worry.
okay. All right. Let's chat in private about that. So, okay, Mr. Chu, I hope that answers your question. Short term bullish, long term could be bearish, right?
Yeah, yeah.
Okay, good. So, next question comes from Steve. Steve is asking, can you please comment on the market condition to invest in China
Mm, okay. Um,
or China
China,
equities? Yeah.
yeah. So my view on China is this: if you ask people in the market, basically, you will find that it is really straight down the middle. There are some people who see the cup half empty, and some people who see the cup half full, i.e., some people see it bearish and some people see it positive. So some people are like, "Oh, it's time to buy." You know, prices are attractive and so on. And China's you can't run away from the fact that China is one of the main places to be and so on and so forth. Okay, I'm a bit tilted more towards the cup half empty because I think what we've seen is structural changes, which means these are not this is really a change whereby you've seen the Chinese Communist Party now publicly saying that we don't like this. We want to be involved, and they are involved in this. I mean, nowhere in the world where you can find a whole sector like the education sector being socialized in overnight. Straight away, you're not supposed to make any profits. I mean, where else can you see such things happening in the world? So that's scary. And that tells you also maybe China now is moving away from the so-called market-orientated economy, which has served it very well all the way since the 1990s. That's how they achieved their double-digit growth and all the massive economic gains that they've seen. But I think they've reached a point where you can't have the cake and eat it, and they are beginning to feel the social ills of it. And I think that they're coming in to clamp down on that. But guess what? In free markets, you can't have the cake and eat it, and you can't clamp down and not expect some repercussions. Example, if you are, they've explicitly said they're worried about runaway credit growth, and this was not now, but early this year or late last year, and they were telling the banks, don't lend out too much because we don't want to create this credit bubble. Guess what? Without that, you are actually you have to hand in hand expect lower GDP. And true enough, China's come out to say, they expect GDP at less than 6%, which was the line in the sand. Okay, so what I mean by that is I think things have changed. Because of that, I think strategies ought to change. You can't go into China now expecting certain sectors to get super normal profits. I think those days are gone. But can you still make money in China? I think you can, but it has to be the other way. Meaning to say, in a crash, in a huge decline like what we saw in the tech side in China, there will come a point where Chinese tech stocks will look extremely cheap from a valuation perspective. So what you make is you make that oversold buy, and then you sell when it reaches neutral position or when it's fully valued. Okay, don't expect it to go from fully valued to excessively overvalued, because I think that's that portion which makes the Communist Party unhappy. Okay, so I think there's still gains to be made, but you need to play it from this perspective lah. That's my point of view.
Yeah, from portfolio perspective, based on the current valuation, China is cheap equity. At the same time, we cannot deny the fact that China will eventually become the economic superpower, overtaking US in maybe in 1 decade time. So, in order to really tap on the potential growth and at the same time manage a risk, just do some asset allocation. There may be 10%, 20% into China equity in that manner. That's my approach.
Right.
But
Thank you.
don't over allocate because
Hmm.
we can't control. And yesterday I think there's one news that actually the summer broker being warned by the China I think the Secretary of Exchange, something like that, being when they share about feng shui, to use a feng shui to really predict the stock market, that kind of warning. But in Singapore, you know that we have a feng shui that kind of seminar in Singapore, we are all okay. I think even Malaysia also okay, but China cannot do it.
Sekali,
I see.
sekali, sekali they ban technical analysis.
Okay, that will be out of this world. Okay, thank you, Sunny and Kenny, for your insights about that. Steve, I hope that answers your question about investing into China. Next question comes from Robert. Robert is asking, do you, Kenny, help set up portfolio construction for people who have preference for primarily the US stock market with very limited Singapore and Hong Kong exposure?
Yes, there is a possibility to set up the US stock managed account. It can be done, right? But just one thing to take note that for investors in Singapore who want to invest in the US stock market, just have to take note on the US inheritance tax and or estate duty, right? So the estate duty portion have to really pay attention to, right? Because otherwise, if something happened to the investor itself, in future, it's difficult for the beneficiary to really inherit all the stocks. That's one thing. The other thing is because of the there's a tax on the dividend itself. It does not really make sense to invest in US for just for dividend purpose. So the short answer is yes, but there are other consideration need to think about it before really investing in the US stock market.
Right. Thank you, Kenny. I think that's a very good point. Two very good point, and that is the estate duty and the withholding tax from dividends. So, Robert, if you are familiar with these topics, then by all means you can DIY. Otherwise, you can contact Kenny for copy for coffee to see how he can help you. All right. So Nick is asking the question. He's saying that most of my equity holdings are index ETF in USD, but I'm a bit worried about long-term value of USD as the world currency. Right? Is in your view, will US dollar lose its global status in the long run, like pound? And if so, how should I allocate my SGP versus USD investment in my portfolio?
Sunny, maybe I go first on a portfolio perspective,
Mm.
right? So normally, I will ask the first question is, what is the original objective you would like to use USD to invest, right? Because for me, that if your all your expense is in SGD, right, you don't have any usage of the USD. I would suggest that using the SGD to invest is better, unless you are planning for the business expansion to maybe overseas, or you're planning to go US to set up business, you need a lot of USD, then you instead of parking your USD into the bank itself, maybe you look for some instrument to invest. All right. So the objective is still very important, whether you should use a SGD class or USD class for your investment portfolio.
Right, right, right. Okay, so it comes back to investment objective. Okay, so Nick, I hope that answers your question. Okay, so let me see. The next question will be from Nelson. Nelson is asking whether it is possible to build a REITs portfolio returning 7 to 8% per annum instead of just 5%.
Yes, the answer is yes, but you need to understand yourself again whether you are able to take it that kind of volatility, because higher return means that is a higher risk. So those REIT with very high yield, basically they have an exposure to the forex, mainly on the USD or maybe the euro. That's why you need to face with the forex, and also you also have a regulation risk because all those property are in overseas, and that they're subject to all the economic condition or some of the government ruling and those things. So those are the risks you need to be aware of, right? And yeah, so short answer, yes, but you need to aware of what are the risks.
Right, right, right. Okay, thank you, Kenny. Um, that would be Nelson. I hope that answers your question. The next question is from Sean. Sean is asking, what do you think of Asian and China high yield bond fund? The prices have been beaten down quite a lot in the past 12 months. Are these good investment for regular dividend income?
Hmm.
Sunny, one thing.
Okay. When we talk about high yield bond funds, we have to understand that high yield, which means high coupons and stuff, equates to low ratings. That's the only way. It means you will be buying into junk bonds, non-investment grade bonds. That's where you get the high yields. Okay, so knowing now that you are investing in bonds issued by companies which are considered to be non-investment grade, the big question is, if the economic situation deteriorates, will some of these issuers go bust and therefore cannot pay you back your capital at the end of your bond period maturity and such? Okay. So narrowing it back down to the two, Asian and China, that's the big question. You can go into China. You can probably get some property bonds, bonds from property companies now, low grade, probably even maybe double B, C maybe, giving you maybe 20%, 15%. But the big question is, of course, will they still be around? So what I would say is you can have some in your portfolio, but don't take too big a bet, because if the deleveraging happens, there'll be more pain basically. Um, don't buy a high yield straight. Don't go and buy a bond paper directly from the market belonging to a property company, for example, which gives you 15% return. You are asking for trouble because you're putting your bet all in one basket. You're hoping that one single company doesn't go down the drain in the next 24 months. If you want to play this game, buy a bond fund, as you correctly mentioned, because bond funds hold 30 bonds, 30 high yield bonds. Even if one goes down, you're not going to be that worse off. So I think that's the key thing. But again, everything is fine. I think if we don't see a huge deleveraging happening, this strategy will yield you pretty good returns. It's just that part of the deleveraging part which I'm a bit unsure of. We've had about 10, 15 years of excesses. We spoke about earlier on whether there will be a huge decline or not. If that doesn't happen, this strategy works. If that happens, this strategy also goes down, because as we deleverage, companies will go bust, so to say lah.
Right, I see. Wow. So, Sean, I think that's a bit high risk. Maybe the crypto
Uh,
fund will be better. Yeah,
but
or
but
maybe
ha-
both.
but, have, but having said that, one strategy which a lot of people are adopting now, in the finance world or in the private bank world, is what we call the barbell strategy, which is if you want to take on high risk investments, and if you, let's say, we categorize this high yield bond as a high risk investment, that sits on one side of your barbell, then you just have to make sure that your other side of the barbell is really very low risk. So because when you combine them together, then you kind of get a kind of nice average out the risk, so to say. What you don't want to do is you don't want to have this and then you have every other thing else. Everything carries a certain amount of risk, and then when you combine all this, you aggregate the risk, you find out that actually you have pretty high risk. Yeah. So a barbell strategy would actually uh, average out the risk, because one side is heavy with high risk, another one is heavy with low risk, and then that works out. Yeah.
Right. Thank you, Sunny, for that input and insight. So, Sean, I hope that answers your question about your Asia and China high yield bond funds. Okay, let's see. The next question comes from SK. Uh, he or she is asking, if I have a spare emergency funds to park into an asset, which asset class is the most liquid to park these emergency funds?
Okay, I'll take that. Singapore saving bond. You give you I think average close to 2% now, right? And the redemption period is only 1 month, right? And you can use the ATM, just press and you can opt it. And maximum per person to park in a Singapore saving bond is 200,000. And you also can park your SRS money. If you do not know what to do, just park in there as an emergency fund. But just take note on the 1 month redemption.
Okay, excellent. So, SK, I hope that answers your question very pretty directly. Thank you, Kenny. Okay, let me see. We are coming to 9:45. We are stretched over by about 15 minutes to make up for the delay in the technical glitch. So I hope this Q&A segment is helpful to those who are still with us here tonight. So let me see what's the next question. Okay, next question is from Steve. Steve is asking, what sort of volatility or drawdown range to be expected in the higher yield REITs, let's say 7% or higher?
Wow. Drawdown, we have one case, high yield rate, used to be close to 10%. You can wipe out by 80%.
80.
80. It dropped from $1 to 20 cents, right? So there always have a reason why the REITs have is high yield, because the reason why they're high yield because of the basically all the big insti or the retail investor just run out from this REIT, and when nobody wants it, the share price plunge. But just bear in mind that all the yield calculation is based on lagging data, is lagging based on the past 4 quarter DPU. So never invest just based on the yield itself. It's very, very risky. While chasing for the high yield, there is a very high risk that you're going to lose money on the capital.
Ooh, okay. So, Steve, I think the message here is to have a diversified portfolio. Then don't just look at one metric. Don't just look at yield. Yeah. Am I correct, Kenny?
Yeah. There are many metrics. You also need to look at gearing. You also need to look at ICR, interest coverage ratio, because at the end of the day, REIT is the debt instrument. They always borrow money to invest in the real estate itself, and from there they generate a rental income. So the metric of interest coverage ratio is very important to check whether the REIT has the ability to really pay off all the mortgage expense, mortgage based on the interest rate. And at the same time, also need to check whether the debt is secured or unsecured. Because if the debt is secured, if they are not able to pay the coupon raised by the bond itself, the creditor that can take away from a property. Once they take away from a property, your share price will plunge also. So there are many metrics. I run a course with SGS Academy on how to do the REIT evaluation, a 2-day course. If you're interested, you can go to the SGS Academy website to check for my course. The next course sometime in June or July. I would suggest that if you're really interested in invest in REIT, probably you need to attend a course so that you have an in-depth knowledge how to do the REIT evaluation.
Right. Kenny, maybe you would like to highlight that the course has some funding provision.
Oh, okay. Yeah, the course fee is $2,000 for a 2-day full day course, and at the present moment, the course, if you are eligible, for example, you are Singaporean more than 40 years old, there is a 90% funding by IBF, Institute of Banking and Finance. So if you net off all the subsidy itself, one person just need to pay $200 for the 2-day course, and this is a certified by IBF. Is the gold standard for the REIT course in Singapore.
Right. So, yep. So if you're Singaporean and you're eligible, above 40 years old, do check it out on SGS Academy website and look for Kenny's 2-day REITs course. And if you're eligible, it's only $200 for a 2-day course. Right, Kenny?
Right. Yeah,
Yeah.
it's the
Okay.
cheapest in Singapore already. I never such as cheap.
Yep. Cool. Okay. So, Steve, I hope that answers your question. Okay, the next question came from okay. Nelson says that I attended the course. Kenny's course is very good, and I recommend anyone to attend. Okay, thank you, Nelson.
By the way, need to pass the exam. There's an exam after the course in order to eligible to a funding. Yeah,
Ooh.
Nelson told me that the exam question is not easy. Yes, it's not easy.
But then make sure that you learn lah. Okay, good. So this is a real thing, not just sit there and listen and then 1 year in, 1 year out. Okay, so let me move on to the next question. Chiho is asking regarding the barbell strategy, the low risk part, is it more referring to cash or short term bond, or can it be big cap equities? While the high risk part, can it include crypto or thematic equity funds?
The low risk part, so it really depends on what it has to balance out. So if you're taking a lot of risk on the high risk part, then the low risk part has to be really low risk. Means to say, if you're going to take crypto, which has volatility of 40% upwards, then your low risk part has to be money market kind of instruments, which has very little volatility, so that when you average it out, your overall volatility falls significantly, or at least normalizes. You don't want to put in your low risk part what we call big caps or stuff which has volatility of 20%. High risk has volatility of 40%. It still averages out of volatility of 30%, so still very high. So you have to kind of consider the volatility, i.e. the risk of both sides, that it works out to bring down the portfolio volatility to an acceptable level.
Right. Okay, so I hope that answers your question, Chiho, about the barbell strategy. You may want to dig further about that strategy online to learn about it before deploying it. All right. So thank you, Sunny. And let me see. Okay, the next question is from Gerard. Gerard is asking, may I know what's the impact of inverted yield curve? What does it have on the equity market?
Okay. For those of you who don't know, I mean, the inverted yield curve basically is when the short-term rates are higher than the long-term rates. Throughout history, whenever that happens, for certain tenures, 2 and 10, stuff like that, technical, it's a bit technical. But when that happens, it signals that a recession is coming. It probably is one of those indicators which I think, if I'm not wrong, has a perfect kind of track record. So recently, we are beginning to see certain inversions. Certain pairs have really inverted. Certain pairs are on the way to inversion, and that is sending out a signal from the bond market saying that there is likely to be a recession, or rather the odds of a recession is growing. Okay. when we place that together, and it's always the case, you just don't depend on one indicator. When you place that together with other indicators, the forward-looking indicators, the one that I mentioned, the leading indicators, the fact that we potentially have inflation in the pipeline which hasn't cropped up yet, because whatever oil price spike we see today, you need to be mindful that inflation doesn't appear tomorrow. That inflation appears 6 months down the road. It causes things to be more expensive. It works its way through the economy and then it pops out. And when you have high inflation, disposable income gets decline and stuff, and that leads to less consumption and leads to lower growth, so on and so forth. So everything seems to suggest that we potentially could get lower growth. The only problem is we don't know how low, because things are quite dynamic in nature. They are ongoing. Okay, but the direction seems to be suggesting we're going to get lower and lower growth. Okay.
Right.
The part where the equity, tying it to the equity part, that's the tricky part, because if we say that there's a lot of liquidity in the system and people are confident enough to deploy that liquidity from the sidelines, then it could be actually supportive of equities. But if people look at lower growth, job being threatened, and less disposable income, and they don't want to deploy that liquidity, and they keep it on the sidelines in money market funds and such, then it's going to be bad for equities. Yeah. So there are a few dynamic stuff going around. So I won't say it's a direct impact, but if you were to say by and large, it should be more downside for equities if we're talking about inverted yield curve.
Right. Thank you, Sunny. Cheryl, I hope that answers your question. Now, the next is the last question. There's a lot of questions. So, the last question is from Terence. Terence is directing this question at Kenny. Can you share your view on Cromwell European Real Estate Trust and Prime US REIT as part of the REIT portfolio, or perhaps a 10% allocation to these two? Are their dividend outlook stable and reliable?
Prime US REIT is basically focused on the US office, and Cromwell basically they have a diversified portfolio in the whole European market and traded in euro. So basically, these two REIT itself, beside the currency, traded currency are different. The portfolio location are different also, and also the asset class also different. So the Cromwell basically they are focusing on the industrial and logistic, and also those factory, and of course they have some office around the whole Europe itself. They have the portfolio in Germany, Poland. And by the way, they have one I think one on logistic in Poland is pretty near to the war zone. That's why the Cromwell, the CEO come out to explain that actually they are not impacted for the time being. And in terms of the past performance, I'm just looking at the DPO past performance. If you're able to look at the DPO trend itself, US prime US rate, the DPO trend is on increasing trend, and one of the warning sign from the Cromwell, the DPO trend is on the declining trend. Okay, so that is some sort of concern, but overall and all that Cromwell has a much more diversified portfolio than a prime US rate. If I'm not mistaken, I think they're close to 100. I don't have a number with me now. They have the number of properties is much more higher in Cromwell than the office. Basically, there are two different asset class, two different animal, right? So if you want to include both of them, you also can be good to have a so-called natural currency hedge, because one is traded in US, the other one traded in euro. So you do not really need to worry about the currency fluctuation, because when US dollar go up, the euro come down. At the end of the day, you just want to convert back to the same dollar for a dividend payout.
Right. Okay, great. So I hope that answers your question. And with that,
Richard, sorry.
yes, go ahead.
I think I just saw Nelson posted something which I think is important for me to just answer that.
Oh, okay.
Yeah. He mentioned about something about interest rates.
Okay, go ahead.
When interest rates go up, true enough, bond prices come down. It's a fixed formula. At the same time, the coupons on the bonds remain unchanged. So you get your coupons, but you lose out on the so-called capital losses on the bond itself. Okay. The important part I wanted to highlight was the part where he mentioned about getting your capital back upon maturity. Do bear in mind that when you invest directly into a bond, That means you buy a bond, a real bond. They call it a plain vanilla bond. True, you hold a bond. Let's say it's a 5-year bond. You hold a bond until maturity. You will get back your capital. Okay. Meanwhile, you get your coupons and then you get your capital at the end of 5 years. Okay. Regardless of where interest goes. The only time you get hit by interest is in the middle of that 5 years. You decide to get rid of that bond, and you get rid of it at a point in time where interest rates have risen. Your capital, your bond price is low. Therefore, you suffer a capital loss. But if you keep it until maturity, you're going to get back 100% of your capital, assuming that the issuer is still around. Okay. But bear in mind, when you buy a bond fund, there's no such thing as maturity in a bond fund. The bond fund is continuous. It's an open-ended bond fund. So while the bond fund holds various bonds, which may mature in 5 years, 3 years, 2 years, and such, you as the holder of a bond fund don't get that, you don't enjoy that so-called capital, inverted brackets, capital protection as the same way if you held on to a single bond. Okay, so I think you need to make sure that yeah, you understand that correctly.
Wow. Okay. Good insight. Nelson, I hope that answers your question. Sorry, I missed your question because it was one of the last few questions. And yeah, I do note that you passed. Nelson said that he passed the exam the first time. Because good for you, Nelson. All right. So with that, we've come to the end of the webinar. Then I'd just like to highlight again, if you want to reach out to Kenny, if you want to DIY, by all means, go ahead and you can rewatch this webinar recording and then take notes and review it. Or if you would like to get Kenny's input and also consult Kenny, you can reach out to him either from his QR code or this link here on the screen, wealthandjoy.com/Kenny Low. There's a form there that you can fill up, and then you submit the form, and Kenny will get in touch with you. And like I said, we've secured, he's a fee-based advisor. So, but we have secured a deal with him where you can have your first consultation fee waived. And just in case you didn't already know, Kenny is a MAS licensed financial advisor. So he is properly licensed to give you advice, right, Kenny?
Yep.
Okay, so cool. So with that, thank you, Kenny and Sunny, for your time.
Thanks for having me.
Very appreciative that you have spent this evening with us to share with our attendees your insights about the market, about the rising interest rate, and what we can do. And may I know whether you have any last words, Sunny, for the audience?
Well, no, I think I would highly encourage everybody to seek out Kenny's service. I think what's important is sometimes as investors, you may know your portfolio, but you always need a third party opinion, someone who's a professional to look at it and say, hey, actually you have a little bit more risk than you initially thought, or hey, you're missing out on something which you may want to plug in here, or hey, this is something which you may find useful to lower down the volatility. So it's really good to have someone to kind of scan through and tell you may have overlooked something, or it's all fine, you've done a great job. So I think that's important. So I would highly encourage that you take the opportunity, especially in this type of markets where we could be hit with periodic volatility, or touch wood, even a downturn. So you need to sit down and bounce ideas off financial advisors who will be able to say, okay, if you think it's that way, maybe we should do this, maybe we should do that. So I think it's very important that you do so.
Right. Thank you, Sunny. And I agree with you too. So it's very important to seek a second opinion, especially one who is licensed and qualified to provide this opinion. Now, oftentimes when we attend courses or seminars, right, they'll say that, oh, this is just for educational purposes. If you need help, you should consult a qualified licensed financial advice, right? So tonight we have it. We have this person, and it's Kenny, right? Because he is qualified and he is licensed to give you that advice. Okay, so yes, Sunny, I agree with you. So Kenny, any last words for our attendees?
Yeah, control what we can control, and don't really need to be worried about those things that beyond our control, because the more you worry, you also cannot do anything, right? So construct your own portfolio, because that's the only thing you can control, and also work towards your financial goal.
Right. Thank you, Kenny. Very nice last words. So again, attendees, thank you so much for your time. Sorry we've extended it by another half an hour. I hope it has been beneficial to you. And if you need to review any of the content, please do check out the YouTube channel to review it. And then if you need, please contact Kenny for second opinion, for coffee, and seek his advice and opinion by using the QR code that he has on his screen, or that he has shared earlier, or wealthandjoy.com/Kenny Low. And with that, thank you very much for your time and good night. And I'll see you at the next webinar. Thanks, guys. Good
Thank
night.
you.
You.
Good night. Bye bye.
Right.
Bye.